Welcome every single one of you to today's FOMC meeting with Jerome Powell, with me, Ivan Vidal. I'm here to help you guide through today. Today we have, suited up for the most important event of this season. So I hope that you are ready. I hope that you are prepared. I hope that you have put yourself into a situation and you're ready, you're born. So today, for this extra day, we have, some extra special, merch. We have extra special bubbles. We have extra zoots. Cheers. Happy to have you here, every single one of you. Today is a special day, so I hope that you have done whatever you need to do. You are ready. You have done your preparations, you have done your analysis, you have done your evaluation, you are ready. So, I just want to yet again welcome every single one of you. I just want to post that I'm live and good to go. Cool. Then we have that one, and then coming into my Telegram group as well, I'm now live. Great. Where else should we post it? Is there anyone else in the world that needs to know that we are live? Maybe God? Maybe the Forex gods need to be with us today. Alright. So, please share your views. What do you think is going to happen today? Is FOMC going to... Is Jerome Powell going to do any changes? Is he going to start thinking about stuff? Or is he going to be just in line with whatever he has been saying all along? Given the new updates on the CPI, given the new updates on the NFP and unemployment rates, are we there? Somebody subscribed. Thank you very much. There is, it's on YouTube right now. That is out. Who is subscribed? Who subscribed? Charanda, welcome. Boom. Cool. So who is here today? We have Don't, we have Sani, we have Luke, we have Ahmad, we have Harold, we have all the awesome people. When will the statement be released? The statement will be released in 24 minutes. So top of the hour, it's going to be released top of the hour. Cool. Pressing record as well for my own safety, so we will get through this today. Cool. So, hello Evan, hello Larry, hello Luke. Francis World is subscribing today, thank you very much. How many minutes until announcement? Yeah, the businessman. Hello everyone, timeline updated. Let's get into it, alright? Let's get into it. Hello sir. We are absolutely a lot of people today. No rate changes, no taper talk. Only timeline update. Says don't wish you were me 100. Good one. That's a good one. What's wrong with this again? Yet again, we have YouTube and whatever. I'm not going to take that on to you guys. But apparently today as well, it's not giving us HD requirements, HD output. I don't know why, but it is what it is. So, cool. Then we should go into the Fed Watch tool. This is the market. This is for today. The market believes, just updating it, the market believes in between themselves that we are going to be 93% of them think we're going to have the current rate change. No, the current rate is going to be stable, no change. 7% is still holding on to there might be a rate hike today. The other things about this tool, it also says that into the future of 15th of December 2021, they're also thinking 3%. 93% of them are still thinking, okay, we then need to keep the rate change as it is. Where do we go? Somebody asked me in the chat today at Discord. I have Discord. There is in the description. I can probably link it up for you. But where do you go? You go to Fed. You go to monetary policy, And at some point in 22 minutes, there's going to be a recent document here. So we're just going to have that open for everyone to see and everyone to do. So every single one of you. What I just mentioned, the Discord channel I just mentioned, it is free. Don't worry. I'm not selling you anything today. Today is only knowledge, 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 knowledge. Okay. Hello, sir. Hello, Danny. 480. So what should we do? Should we start a whole new stream just to get up to 1,000 so you guys can see me better? Are we going to do that, or are you guys gonna? Am I gonna lose you then? Huh. How can we change that? I really hate that when it happens. I really hate it myself though. So vote. What should we do? What are you saying, Harold? Not a problem. Just when you were going pivot points introduction, and we couldn't see the details. Ah, okay. That's bad. Okay. So this is good, but alright. Then we are going to go. Technical difficulties as always. I hate that what happens. But anyways, thank you guys for being here today. I do love every single one of you here today. Couldn't done without you, so let's see how things go. Alright, cool. We need to see your wrinkles. You are so funny, huh? See? I have wrinkles, you know. And then the reason why I'm losing here is because of all the stress in my life, right? Okay. Then we need to change that. Then we need to go through that. So, then I want us to go through, I think it is on FX Street. I'm not sure. I'm just winging it at the moment. Where they were going through 10 major banks and wouldn't so let's go through them. CE, things, no rate change, but some optimism is evident. TDS think the tone will probably be slightly less dovish than April. ING says that they're going to leave the interest rate unchanged. Again, play down taper talk. Because people, let me give you a history lesson, okay? The history lesson here is that when last time they were unwinding or reducing their quantitative easing, it went horribly wrong. So there's something called taper tantrum, where I think it was in 2000 and was it 18? I don't know, 8 something? No, 18 maybe, or 13, whatever. Some years ago, they were trying to unwind their balance sheet, the bonds they have bought. They just did it like that. Nothing in advance. They just Benarchy just did it. That created fear. It created shock. It created a massive sell-off that was unnecessary. So, the Fed is this time trying to do, Jerome Powell is this time trying to do, is to hint. So the market can slowly, starting to get used to this is no longer, we're going to change policy, okay? That's what they're trying to do. So last time it went totally wrong. So the market has a prehistory of, this didn't go well. Okay? Assalamu alaikum, brother. Salaikum assalama. Is it salama? Salam alaikum. Alaikum salam. So if it hints, it is true, it seems the range won't change. The rate is not going to change, okay? The rate change is still 2023. But what do you start first with? Do you start with bond purchases, or do you start with the interest rates? You start with the bond purchases, because that can just be just small, or just, you know, you can start slowly with that. Interest rates is sudden, it's hard, it's very harsh, it's very boom in your face, okay? So they can start off with QE, less and less bonds, start selling off their bonds to the banks again, getting some money back from the market. So that is where they want to go. And I think they will start off with the mortgage-backed securities first, then the bonds, then the interest rates. So we'll see. Also, if they're going to start talking about the framework, okay, framework means how are they going to decrease their bond purchases? How are they going to stop? That's the framework. Now, plan or a strategy or whatever you call it, you know. So, Angie says the market will be looking for hints whether the Fed is starting to acknowledge that inflation may not be transitionary. The thing is, Fed says back in April, back in March, whenever they had the last meeting, was there is going to be a high inflation, but it's going to be transitionary. It's going to be high, but short term. So the clue becomes now, how long is this transitionary going to be? When does it become long term? When does it become solid? That's kind of the point that we need to look out for to do as well. Looking sharp today, Abbas. Thank you very much. So, Rabobank also thinks that given the recent data, the economic projections of FOMC participants are likely to see forward revision for the PCE inflation in 2021. The thing here is, there is a dot plot, okay? We can find dot plot. Fed. So there's a dot plot here. Okay, maybe you can find some dot plot somewhere. Hopefully you can find it very fast. I didn't prepare that one. Whatever. Dot plot here. Dot plot is what the governors in the Federal Reserve Committee thinks is going to happen for the future. But do remember, it is not reliable because it changes as fast as the wind changes. So if there is a worse CPI next month, if the NFP is worse than they were expected, this will change. So this is just kind of the current wind, you know, where your forge goes at current. So the current is that they think the new projections are a bit, you know, higher. But do remember, when we're coming into this, that they're thinking, you know, majority is either 2.37 or oh yeah, no, this is actually wrong. This is actually from the wrong. This is actually wrong. Really? Come on, nothing new. My point is, dot plot is where the Federal Reserve Committees thinks is going to be the interest rate for the future. Okay. Now, it's going to change, and it's not always as actual as they want it to be. So, longer term, they think interest rate is going to be at 2.5. For 2021, most of the thing we're going to have, this is December 2016, by the way. Most of the thing 2021, we're not going to have any increase. For 2022, there is one guy that increases. There is this guy called Kaplan. He's been out talking that we need to start thinking, we need to start tapering, we need to do nini. That's the guy that's been kind of running the market as of late. Jerome Powell has been straight on point every single time. So this guy is kind of created a mess for me because he creates dollar bullishness just out of the blue. So when the Kaplan starts speaking at his conferences or whatever where he is, you just see dollar rises. And I'm like, Kaplan, what did you tell today? And then he's like, nah, we need to assess the situation. We need to see that CPI is now going higher. You know, we need to start talking about the framework, blah, blah, blah. So that's the guy that's most bullish at the moment. So that's interesting to look at what the members themselves are thinking, but in the end, it's the whole board as of much. And they're still not going to change in 2021. They're still not going to change in 2022. But they can start talking about tapering in September. They can maybe taper in December or in January next year. And then increase interest rate in beginning of 2023. That is totally according to plan. Sharp. Video quality is very low. Okay, so 61 of you guys. Should I restart a live? Come back with better quality? Is that what you guys want me to do? I really hate 48p. Can we do that? Will I lose all of you then? Or can you just guys hang on? Abba says it's okay. And says he said yes. So that's just 2 of you guys. You see me clear, but it's 48p. Aha. We can survive. I don't like surviving. I want this to be sharp. I want to be as sharp as me today. And the system is not... Okay. I'm not going to bother that anymore. So. Using 5% of my CPU today for this shenanigan today. Is there nothing else I can do? You cannot change the settings when you're live. Okay. It's my settings, yeah. And I need to have a totally new live to do it. Will you guys leave? Doesn't affect the message at all, Patrick Rosenberg. You sound Swedish, by the way, or Norwegian. Rosenberg sounds Norwegian or Spanish. We are going to focus on gold today on the FOMC. Yes, what the reaction in the market will be. So the time plan right now is FED is going to release their meeting minutes in like 10 minutes. We're going to watch that. Then we're going to watch the reaction in gold. Then we're going to watch together the conference at past. So yeah. Mohammed says, I don't think the market will be much affected, but nevertheless, it is going to react if there is a new thing coming in here. Okay? If there is a new change, which is all possible, by the way, which is all very possible. It's going to be a taper tease. You know, we all love to be teased, you know. Just a little bit, right? Just a little bit. What do you think about UCAD? Okay, we can start going into some charts now. I'm sorry for talking too much. So, for those who knows me very well, I'm actually doing a pivot point video today. So, do remember, I will probably delist this live and then put up the best views later on, okay? My commentary. So I hope to make that video today, so you will, you know, be nice and welcome. So USD CAD as of late is turning around. Dollar is strong, and I do use pivot points, Wayne's pivot points, by the way. This is monthly. So if you're a buyer, you're looking to buy in this area here, and if you're a seller, you're looking to sell here. Aha. Very conveniently. The thing is, we wanted this to be down here, and then jump here, and then probably by here by now. That didn't happen. So, what do you think about USD CAD? USD CAD is currently bullish, and can go higher. Up to 2271. and then see. If it stops at 22.70, if it goes to 23, I don't like that. I hate that. I don't want dollar to be strong. CAD is weak for some absolutely unknown reasons. Coming into gold. Is there any gold diggers in here? Any gold diggers? You can't see my chart. Any gold diggers coming into the chat today? I can see there is a couple of here that is into gold. Hej, hur man du? Ja, jättebra. Gold and hold. Gold and hold. Yes, my John Butcher is a gold digger. Nagano says, woo! That's so amazing, people. So, if you are new to my channel, my name is MBDL. I'm a forex trader and an economist. I do have an master's degree in these economics things. If you are one of those 4,073 people that subscribe to my channel, thank you very much. Though today we are into Fed, we're into gold, we're going into what dollar is going to do today, and we are going to look what the Fed is really going to tell us today. So they are our god. They are the reason why price moves in whatever direction, overall trends. So they decide where the trends are going to go. And like, how's that possible? How do you know that? Well, ladies and gentlemen, let me not disappoint you. This is where BOC said they're going to increase interest rate earlier. And then CAD strengthen out of this world. Okay? This is where Fed said zero interest rates. This is where CAD said low interest rate. I can't remember. Was it 0.25 maybe? Low interest rates. And just went absolutely mayhem downwards again. So that's how they can churn the market 2,400 pips from when they said, not anymore. Okay? That's the power of central banks and the Feds and Bank of Canada for USD CAD. Okay? So, be respectful. Don't hate on him. Don't hate on Jerome Powell. He might be saying a lot of things that you might not agree with, but as traders today, we have a couple of things we need to see. We want to see price to go above 1865, 1870, or we want price to hold 1760 if he starts talking about tapering. Okay? Remember, those are prices if it falls that much. Okay? If it falls that much, I do hope that your account survives that. I don't think it's gonna happen, but I do post it article today where the first hour is most like 90% of the volatility after a surprising Bank of Canada meeting. So there's a new change that market didn't anticipate. The first hour is the most important hour where there's most volatility. That means that if you try to come back one after later, like saying, yeah, I'm going to pick up this trade, it might be too late. So you say going up to 1870 to sell off. I think that's a bit narrow. And I would rather sell from, I don't know, 1880 maybe? Rather. Okay. Patrick Rosenberg says, why do you think Powell went into Fed as a Volcker and would leave as a Yellen? Privy to the information or again to I don't know his reasons of why he went there, but you know, now Yellen is Secretary of Finance instead, so now they're friends. So Powell is just well, what do you call a doo-doo instead of doo-doo? To do whatever that he's been told to do. He's just doing what he's doing. It's go time! So, for those who can't see behind my face, there is... we have 1 minute left, people. We have 1 minute left. So there's a countdown here. I just need to see here. Countdown to FOMC meeting minutes. That's where everyone can see that. 1 minute, 50 seconds. Hold your breath. Keep your stop loss at break even or better. Hope you have not lost all your money from now. Because right now, I hope that we can get a bearish trend on dollar. Start selling dollar again. Just do whatever we always have been doing. Yeah, that's what I want to see. So, and none further ado, I hope you have subscribed to this channel. I hope you have liked this video. And I hope that you like what you're going to go through today. So, I'm going to give my comments whenever this is out. 15 seconds left. Let's go! Updating. Gold is falling, gold is falling, gold is falling. '60th of June is out. Here we are. Gold getting in. Everyone's refreshing. I'm giving it to the... There you are. Okay, so it's using fill ratio to support economy, whatever, progress. The progress and strong policy support indicators of economic activity has strengthened, so they have mentioned that the economy is doing well. Sectors have adversely affected by the pandemic remain weak, but shown improvement. They're commenting about the economic improvement. Inflation has risen, largely reflectory transitionary factors. Overall, financing conditions remain accommodative. In the part of reflecting policy to support the economy to flow of credits to U.S. households and businesses. So there is no change whatsoever. Cool. Just hope having that one here too, and then there, and then everyone. Cool. Dollar jumps. Yeah, of course it jumps. So, gold is still here. Gold is still alive. Great. Going to continue to read through this article thing. The path of the economic will depend significantly on the course of the virus. Progress in the vaccination will continue to reduce the effect of the public health crisis. Whatever. Expect to maintain a accommodative stance of monetary policy and these outcomes are achieved. 2%. To achieve inflation moderately above 2%. I think that's a change. That's a change in wording right there. For some time, so that inflation average above 2% over time and longer-term inflation expectations remain well anchored at 2%. Okay. Committee expect to maintain accommodative stance and monetary policy until these outcomes are achieved. They are keeping the rates as present. Okay. In addition, the Reserve will continue to increase its holding of Treasury securities by at least 80 billion a month and mortgage-backed securities by at least 40 billion a month until sustained substantial. So everything is similar here. There's nothing here. Nothing new. In assessing the appropriate stance for monetary policy, yada. Cool. Okay. So somebody subscribed. I don't know who it was, but welcome very much to you too. Let's go to what they are talking about. I believe that they are seeing the same thing as I do. And then I will turn off the notifications for these ones, so you guys are not bothered with it. How do I turn it off? Turn it off. But yeah, so dollar falling, euro dollar falling hard today. Not what I want to see, but it is what it is. Dollar making a new higher high, going up to 91 today. We have the 10-year T-note stuck. I think it's maybe out of the market. Maybe the market is closed. That's why it's not reacting at the moment. Well, really weird why that is not moving today. DXY absolutely flying. So for those who made money today, boom. I hope that you are winning today. The instant spike on EURUSD was instant, yes, because big money players are out of the market, so there's less liquidity, so price has to go further to find liquidity. That's why we're seeing the price spike. And we have been pairing for this one for a long. EURUSD, where are we going right now? 2050, coming down to 2050. I hope that we can hold 120. So that we're just going to reset down to 120. Coming for the monthly pivot points. I think that's a target for the month. So if it comes down to here, or it's 1950. I don't want the price to go below 120, by the way. So if you go below 120, basically my bullish plan is screwed over. So yeah. I know you told me no change, bro. What happened? No change, but they have acknowledged that there is improved economics in America. Therefore, that tapering is probably more evidently. Then the thing is that okay, but that's not new, is it? That's always been like that. So 13 Fed policymakers see the first rate hike in 2023. The U.S. Federal Reserve, the seven policymakers sees lift off in the Fed funds rate from 0 in 2022 compared to 4 policymakers back in March. So 7 sees the lift off from the funds rate from 0 in 2022 compared to only 4 back in March. Additionally, the number of policymakers sees lift off in the Fed funds rate from 0 in 2023 rose to 13. So the Fed members has become more bullish. That's why the dot plot has risen. Therefore, we are seeing the dollar strengthening right now. Therefore, we are seeing what we are seeing. We didn't know it is advanced. And we have Jerome Powell coming in 25 minutes now. Then we'll see what he says. But yeah, that's what it is, brothers and sisters. Nothing we can do about it. You're short from 21.20. Great, good on you. Happy for you. Don't wish where you meet. 100. Gold crashing. Have a sell at 1900. Yes, sir. Patrick, what did you say? I don't really want to know what you said. Bitcoin at 34,000. That is interesting, and this one should also fall, by the way, if you're wondering. We are looking to stock market as well. Stock market is also reacting instantly here, coming downwards, seeing that whatever is helping the stock market as of late is probably going to end sometime soon. I'm still hoping for these levels, by the way, people. We are still very elevated. We made higher highs yesterday. So if we can come down to 41 or 41.29, 41.60, 41.30, that would be so much more amazing on S&P 500. Nasdaq absolutely crushing it today. Falling 94 points, down 0.67 on the day. And yeah, also very elevated at the moment. Hopefully it can come back down again so we can take it back higher. That is the only reason, right? You can see it here. It's very elevated. Almost come down up to the monthly target. We want it to come back down here so we can take it up again. That is the plan. All right. You got peps. I'm happy for you. Target is 120.03. Okay. Happy. How can people trade in this second? The news comes out. They don't even know what it says yet. Happy day. That is their risk. And if it was against them and dollar did not strengthen, dollar fell instead because there was some kind of If there was the opposite if there was opposite communication out of the Fed, they would have lost a lot of money, and they probably wouldn't have told you now that they either blew their account or blew up their stop losses because of slippage. Some of them had very good interest, some of them didn't. But it's up to them. I cannot control you. I cannot control what you're doing. So if you're getting money today, you did a lot of risk. You need to be paid really well today since you took a lot of risk. So I'm happy for you that you made money. But that's not how you make money, generally speaking, people. Just having a warning for you. Alright? Like similar scenario with last year, June. I will expect risk off for at least 2 weeks. Says Raphael. Okay. Confused why Dixie rises on the news. No rate hike and content asset purchase. Patrick, I think I just said it a bit earlier. I would say it again. The reason why the dollar rises now is because the Fed, the dot plot of the Fed we were talking about earlier, has risen. So their expectations for future when the rate hike is going to happen has increased. Okay, so here we have projection materials. So there is a change here where a lot of people is now all of a sudden, you saw the previous one where we were not really, a lot of people were thinking in 2022. Now 2 people are thinking up to 0.75. 4 people are thinking up to up a half a basis point, and up in 2023, so 2 people are thinking 1.5. Okay, so and almost everyone think longer term we're going to be up to 3%. So there's a change. I'm going to find that projection, by the way. Let's do that very fast. Projections. If you saw back in March, we looked at the same one over there then, and then I'm just going to be fast. Where is it? So is this transitional spike in the market? I wouldn't say so, bro. I would say that whatever they're talking about right now is that they are seeing that whatever is happening right now in the market might be more than they anticipated, by the way. Yeah, okay. Here we are. Back in March, there were 18 people were thinking no change in 2021. 14 people were thinking no change in 2022. And then we saw today, there was, I said, 4 people thinking there's going to be rate change. Now there is 6 people. Now there's 7 people thinking rate change in 2022. In 2023, only 5 people thinking no change in 2023. Here, there is 11 people no change. So, 7 people, 7 board members moved about the projection for 2023. And 7, is it 7? 7. And 3 people moved for their projection for 2022. That's why we are now seeing what we're seeing. Is it difficult to see? Yeah. 14, 11, 18, 14, 11, and then this today it is, maybe I can find the same thing today here. Nah, it's a different material thing. Yeah, so yeah. They're also probably upgrading their growth forecast, to be honest. GDP to 7% from 6.5 this year. So that's what I just said. They're increasing their growth forecast as well. So 7% people. They're expecting 2 to 3%. That's kind of normal GDP. 7% is pretty high. So stocks are down. All there, no fireworks at the moment. Core going to be 3% and PCE 3.4. So yeah, now we're just waiting for Mr. Powell and what he thinks about the future. He is gonna have a difficult job today. He is gonna have a difficult job today. I'm just telling you. This guy is gonna have a difficult. So if I give you any value today, please hit the like button. I'm gonna say that for the last time. I'm just trying not to do that too much. And if you have gotten any value today, I hope that you also stick around and increases this. Thank you very much for those 3 new subscribers. Happy to have you guys on board. And if you're here for the first time, I hope that I make you comfortable. I hope I make you understand these markets a bit more. And why is this falling? What is happening in the market? Your account is blowing up, maybe. What is happening? We might have a new policy coming in soon. The market is positioning for this new policy that is coming sooner than we thought. As of what was priced in earlier today, DXY is coming up to R1 for the month, and dollar USD CAD is coming up again, up to 22.60 soon. So where will this end? Gold has turned into the gold hole. Let's go into gold. I know you guys love gold, but okay. We have come down to the monthly target, no monthly buy price for M2 on the month of gold. Not that that matters anything, because currently we are bearish. And if it is supposed to hold anything whatsoever, this is my second price I mentioned to you guys before. It was either 1862, 1836, which is where we are now, or 1763, and I hate to see price going down so much. So if I was to trade today, what would I have done? I probably would have bought dollar, and I'm here with you guys, so I'm not making money by sitting here. So I hope you appreciate that, taking time to explain you what the market is doing right now. Let's go into the YouTube channel for the FOMC so that we are prepared for them. FOMC. Where are they? There's a lot of people going live right now. We're just waiting for them. Cool. I think these things won't last. Liquidation cascade. Yeah. So what is really happening right now is that large investors are now repositioning themselves. They're thinking, if we are now going to have less support into the economy, is this really a good place to be in? Maybe not. Maybe not. All right. So they're exiting their buys on euro. They're exiting their buys on Aussie. We can go down to the indexes. Dollar is of course rising. Australian is of course falling. The British pound is of course falling. Euro is of course falling. Japanese yen is also falling. The New Zealand index also falling, and the Canadian is also falling. So what do we understand of these market moves? Okay, dollar is rising, everything else is falling. Even even Swissy is falling today. Yeah. So Gambler says, so there was a couple of guys I need to reach out to. There is Emmanuel, there is Sabev, that is gold buyers in my group, and they always trade against me. So happy, congratulations, happy birthday. You guys are probably making a killing today. I'm so super happy for you today. You guys are amazing. So everything is falling. Everything is just falling today. I'm going to take a sip of coffee today so I can so I can be awake for you guys, alright? Cool. Alright, good to go? Still good to go? Some extra bubbles. Alright, chat, we have 10 minutes until this guy is out there. 2:30. Yeah. So dollar's the only one winning. No. Not really, no, not really. The reason why dollar's not winning during Turkey is because the euro, the ECB wants their currency to be low, the Australia wants their currency to be low, New Zealand wants their currency to be low, Swissy wants their currency to be low, Canada wants their currency to be low. So dollar is the only one losing out, because now whatever the other central banks are just getting what they want. This is what they want. This is what they're hoping for. This is like they're praying for. This is their wet dream happening in front of them. Euro hates 122, 120.37. They hate it. You know, remember back in COVID times where we were back in, let's say, 108, when we were back here? There is no ECB member that says, hey, this is too high. This is good. Why? Because more people will buy European goods. What is Europe mostly exporting? Can anyone tell me what is Euro exporting? Anyone? What is their biggest industry? I have two things on my mind that needs to be responded to. Can you look at silver? We can look at silver. Hello, Solomon. We have a Fed meeting today where they are raising their forecast. They're seeing that the economic improvement in America is doing well, that more and more people are getting employed, the price pressure is getting higher, things are getting more expensive. They are getting closer and closer to their targets. So by 2023, more people at the Fed thinks we're going to increase interest rates. More people at the Fed thinks we're going to increase interest rates in 2022, no 2023. So from 4 people to 7 people, and then from the other one was 7 more people think 2023 are going to increase interest rates. So that is very, I think all 18 of them are looking to increase interest rates in 2023. So looking into commodities like silver. Silver is range bound at the moment on daily. This is very little reaction, by the way. This is very little. reaction. We are waiting for this one to go higher. So whatever happens today doesn't really bother me. It doesn't really make me nervous. If you already have buys in here, I'm sorry that you are in loss or that you are thinking of break even. You do. If price goes below 27, you probably want to get out. And currently price is pulling back, so you are pretty good at the moment. Cars. Yes, sir. Yes. But what is Europe's biggest export? Cars is the first one, but what I was thinking was, I was thinking of automotive parts, and then I was thinking of Airbus. Okay? Airbus, but maybe not then. Apparently not. Where is aircrafts at number 10? Steel, organic chemicals, opticals, plastics, mineral fuels, pharmaceuticals coming in as well from Switzerland. Electrical machinery, vehicles, machinery including computers. Alright, cool. There it is. So I'm going to kill my own music right now, and I'm going to listen to what the Fed music is, so we can all remember that they have good, that we are getting in when they are getting in. So just mixing where their sounds levels is. Desktop. Hope it's not too high. Tell me if it's too high, by the way, so we can take it down. Airbus and Boeing was not good for us pushing on euro. Yeah, there was a war that was apparently ended when they were running after each other for saying that they're getting illegal sponsorship from governments, which is, yeah, that's what they do. That's how they keep them afloat. So I really don't like Boeing anymore because of the air crashes with Max. Mostly because they merged with McDonnell back in those years. And apparently the culture in Boeing at that time was all about innovation. It was all about security. It was where it was supposed to be. It was healthy. Now the report comes out. Apparently it's all about profits. The reason why I say that about Boeing is because they didn't want to train the pilots on the new MAX system, the MTAC, which led to the crash, because it will take them longer time until they can start using aircraft. Who on their wildest dreams does that? Only stupid people. So if I can choose between Boeing and Airbus, I'm gonna choose away Boeing any single time. And I love aviation. And I can't choose between Boeing and Airbus, but if I'm able to when I'm travel, I will not choose Boeing. Just because of those leaks. Maybe they're right, maybe they're wrong, but it's something wrong with America. American corporate, there's something wrong when they can fire you on the spot the same day. Doesn't matter. You came 5 minutes late. And then there are reports that saying we need to fix this, never fixed. So that's maybe me in Europe. Maybe I'm wrong. I'm sorry. I'm offending somebody. But American culture, corporate culture, it's not like Europe. Boeing has 787 problems too. Yeah. I mean, why do you use IDC charts data for gold and not a broker chart? Dollars? I don't know. Is there something wrong with IDC? Like, I use both XAU USD and I use gold. So those are TVC. Both of them. So both are showing me the same price at the moment, around 1840. So yeah. Is there any other gold providers out there? It says it's the first one. Sometimes, yeah. CFD out of currency.com. Okay, cool. Great. Boeing jilted Embarrass at the Ultra as well. Yeah, I love Embarrass though. Embarrass looks like great. It's a Brazilian manufacturer, that make small airplanes. So yeah, coming into this FOMC meeting, come on, Powell, we need you now. We are waiting for you so long right now. All right. So was there something new today? Yes, there was something new today. Was it expected? Yeah, it was. Was the market reaction worse than expected? Yes. I did not expect the market on Euro USD to fall 80 pips. I honestly did not think that's gonna happen. But I'm here proved to be wrong. I didn't lose money on it. That is my first goal as a forex trader, as a currency trader, as an investor, as an expert, as whatever I do. My first goal is to not lose money. Then I will try to trade in conditions I want to be in. And currently, your dollar is not rising. So, yeah. The reason is, the thing is that if we now rise and we end June high, that is going to set up July like that. I want July to do that. So, if we end low, like here, maybe we can get a rise, a pay rise in July. So right now, I think we're just gonna fall, and I think we're gonna consolidate, and then from July we're gonna go either up or down. Ladies and gentlemen, the sun went off. I don't know if there. Time is set, everyone. So, in great honor of the ladies and gentlemen, let's see if he can come on soon. I will put that on full screen, and I will.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. And maintained our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades. Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Household spending is rising at a rapid pace, boosted by the ongoing reopening of the economy, fiscal support, and accommodative financial conditions. The housing sector is strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. Forecasts from FOMC participants for economic growth this year have been revised up since our March summary of economic projections. Even so, the recovery is incomplete, and risks to the economic outlook remain. As with overall economic activity, conditions in the labor market have continued to improve, although the pace of improvement has been uneven. Employment rose 419,000 per month on average in April and May, with the leisure and hospitality sector continuing to post notable gains. Employment in this sector and the economy as a whole remains well below pre-pandemic levels. The unemployment rate remained elevated in May at 5.8%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months against a backdrop of rising vaccinations, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.5% at the end of this year and declining to 3.5% by the end of 2023. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably in recent months. The 12-month change in PCE prices was 3.6% in April and will likely remain elevated in coming months before moderating. Part of the increase reflects the very low readings from early in the pandemic falling out of the calculation, as well as the pass-through of past increases in oil prices to consumer energy prices. Beyond these effects, we are also seeing upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly as supply bottlenecks have limited how quickly production in some sectors can respond in the near term. These bottleneck effects have been larger than anticipated, and FOMC participants have revised up their projections for inflation, notably for this year. As these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal, and the median inflation projection falls from 3.4% this year to 2.1% next year and 2.2% in 2023. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of monetary policy. The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of COVID-19 and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed, and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now. More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative. Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month, and of agency mortgage-backed securities by at least $40 billion per month, until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals. As we have said, we will provide advance notice before announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Mr. Chair. First, we'll go to Rachel Siegel, The Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can walk us through expectations you have specifically when it comes to the labor market going into 2023. And I'm curious about people who may have left the labor market, who have yet to come back, or who may face issues with childcare, perhaps they've retired early, any barriers that you see keeping people from the labor market as you consider full employment going into 2023. Thank you.
Thank you. So I would say if you look at the labor market and you look at the demand for workers and the level of job creation and think ahead, I think it's clear, and I am confident that we are on a path to a very strong labor market, a labor market that shows low unemployment, high participation, rising wages for people across the spectrum. I mean, I think that's shown in our projections. It's shown in outside projections. And if you look through the current time frame and think 1 and 2 years out, we're going to be looking at a very, very strong labor market. In terms of exactly what that means, we'll have to see how things evolve. I think we learned during the course of the last very long expansion, the longest in our history, that labor supply during a long expansion can exceed expectations, can move above its estimated trend. And I have no reason to think that that won't happen again. At the same time, we have seen, in terms of participation, we've seen a significant number of people retire. And so we don't actually know exactly what labor force participation will be as we go forward, but I would tend to look at it and think that it can return to high levels, although it may take some time to do that. But overall, this is going to be a very strong labor market. In terms of the near term, you ask as well. So we see a couple of things, a few things that seem likely to be holding back labor supply. There are very large amounts of job openings, and there are a very large number of people who are unemployed, and the pace of filling those jobs somehow feels slower than it might be. So I'd point to a number of things. The first of which is just that most of the act of sort of going back to one's old job, that's kind of already happened. So this is a question of people finding a new job. And that's just a process that takes longer. There may be something of a speed limit on it. You've got to find a job where your skills match what the employer wants. It's got to be in the right area. There's just a lot that goes into the function of finding a job. So that's sort of a natural thing. In addition, I would say that we look at, for example, a significant number of people still say that they're concerned about going back to work in jobs where there's a lot of public facing because of COVID. So that's clearly holding back some people, and that should diminish as vaccinations move ahead. There's also the question of childcare. Many are engaged in caretaking, and as schools reopen and childcare daycare centers open in the fall, or not in the fall, then we should see that supporting labor force participation by caretakers. Finally, unemployment insurance for something like 15 million people will either end or be diminished as we move through the summer and into the fall by the end of September. And I'd like some that may also encourage some to go back in and take jobs. So you would think that that would add to an increase in job creation as well. So you put all those together, I would expect that we would see strong job creation building up over the summer and going into the fall. I will also say, though, the last thing I'll say is this is an extraordinarily unusual time, and we really don't have a template or any experience of a situation like this. And so I think we have to be humble about our ability to understand the data. It's not a time to try to reach hard conclusions about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient. And I do think, though, that we'll be seeing some things coming up in coming months that will inform our thinking.
Thank you. Paul Kiernan.
Hi, Chairman Powell. Thanks for the question. The committee's medium forecast on inflation seems to assume a pretty tame outlook for the rest of the year. As you know, the 3-month annualized rate for the past 3 months was, I think, 8.4% in the CPI. And I'm just wondering sort of how much longer we can sustain those kinds of rates before you get nervous. Thanks.
So inflation has come in above expectations over the last few months. But if you look behind the headline numbers, you'll see that the incoming data are consistent with the view that the prices that are driving that higher inflation are from categories that are being directly affected by the recovery from the pandemic and the reopening of the economy. So, for example, the experience with lumber prices is illustrative of this. The thought is that prices like that have moved up really quickly because of the shortages and bottlenecks and the like, they should stop going up, and at some point they in some cases should actually go down. And we did see that in the case of lumber. Another example where we haven't seen that yet is prices for used cars, which accounted for more than a third of the total increase in core inflation. Used car prices are going up because of sort of a perfect storm of very strong demand and limited supply. It's going up at just an amazing annual rate. But we do think that it makes sense that that would stop and that, in fact, it would reverse over time. So we think we'll be seeing some of that. When will we be seeing it? We're not sure. That narrative still seems quite likely to prove correct, though, although, as I pointed out at the last press conference, the timing of that is pretty uncertain, and so are the effects in the near term. But over time, it seems likely that these very specific things that are driving up inflation will be temporary. And we'll be we're going to be looking. We'll be looking at the monthly pricing data. I'll also say that the labor market is going to be important both for the maximum employment goal, but also for inflation. And we'll be looking at that. And as I mentioned, we expect, and I expect, that we'll see increases in supply over coming months as the factors that we believe have been suppressing supply abate, wane, move down. So I can't give you an exact number or an exact time, but I would say that we do expect inflation to move down. If you look at the forecasts for 2021 and 2022 and 2023 among my colleagues on the Federal Open Market Committee, you'll see that people do expect inflation to move down meaningfully toward our goal. And I think the full range of inflation projections for 2023, it falls between 2 and 2.3%, which is consistent with our goals.
Thank you. Now we'll go to Ilan Mui at CNBC.
Hi, thank you, Chair Powell, for doing this. My question for you is that you mentioned that your colleagues did have a discussion about the progress that you're making toward your goals in order to consider tapering your asset purchases. In that discussion, you said that you haven't made substantial progress yet, but that you expect to continue to make progress. In that discussion, did you guys talk about a timeline for when you expect to see that progress be made and when you might consider starting to reduce those purchases?
Right. So I expect that we'll be able to say more about timing as we see more data, basically. There's not a lot of more light I can shed on that. But you can think of this meeting that we had as the talking about meeting, if you like. And I now suggest that we retire that term, which has served its purpose well, I think. So committee participants were of the view that since we adopted that guidance in December, the economy has clearly made progress, although we are still a ways from our goal of substantial further progress. Participants expect continued progress ahead toward that objective. And assuming that is the case, it will be appropriate to consider announcing a plan for reducing our asset purchases at a future meeting. So at coming meetings, the committee will continue to assess the economy's progress toward our goals and will give advance notice before announcing any decision. The timing, of course, Ilan, will depend on the pace of that progress and not on any calendar.
Thank you. Now we'll go to Chris Rugaber, AP.
Right, thank you. Well, you mentioned, let me ask about inflation expectations. You said they were, I think you mentioned in your opening statement that you saw them as within target. Does that mean that some of the shorter term measures we've seen out there, such as the New York Federal Reserve's 3-year outlook, which jumped a bit, should those sort of be dismissed? And are we only looking at longer term inflation expectations? And would you describe those as still well anchored at this point? And on a related note, would the Fed consider publishing its index of common inflation expectations on a monthly basis? Thank you.
So we do tend to look at the longer term inflation expectations because that's really, we think, what matters for inflation. The shorter term ones do tend to move around based on, for example, gasoline prices. So you'll see if gasoline prices were to spike, you'll see the shorter term inflation expectation measures, particularly the surveys, move up. And that's maybe not a good signal for future inflation if gas happens to spike and then go back down again. Yes, I think if you look at the broad range of longer-term inflation expectations, they've moved up. They moved down at the beginning of the pandemic, sort of further exacerbating concerns that we might find ourselves where, for example, the ECB and the Bank of Japan have been, where you have expectations and inflation itself sliding down, and you have a really hard time stopping that process once it begins. So that was a concern. So it's good, actually, to see longer-term inflation expectations move back up to a range. It's a range that's consistent with what our objectives are. These are not precise measures, and they contain risk premiums of various kinds, and that's why we look at a broad range of them and tend to look at the movement of that broad range of indicators, which are from surveys of economists, surveys of the public, and also market-based. It's a wide index, as I'm sure you know. We look at that and we see them back in the range where they were. Of various kinds, and that's why we look at a broad range of them and tend to look at the movement of that broad range of indicators, which are from surveys of economists, surveys of the public, and also market-based. It's a wide index, as I'm sure you know. We look at that and we see them back in the range where they were, and by the way, they've been broadly higher than that, somewhat modestly higher than that, not so many years ago, at a time when inflation was still anchored and at around 2% or maybe even a little bit below. So the answer is yes, I think they are anchored, and they're at a good place right now. It's gratifying to see them having moved up off of their pandemic lows. And as you know, it's fundamental in our framework, our new framework, to assure that longer-term inflation expectations are anchored at a place that is consistent with our goal. We think that's an important reason. If inflation expectations are not anchored at a place that's consistent with your goal, it's not clear why you would expect to hit your goal over the longer term. So it's important.
Okay, now we'll go to James Politi with the FT.
Chair Powell, Hi, thanks, Chair Powell. Your economic projections today forecast 7% growth in 2022, unemployment for 4.5%, and core inflation of 3%. If those conditions are achieved by the end of the year, would that constitute substantial further progress in your mind? And kind of more broadly, when you look at the sort of median forecast for interest rates in 2023, showing not one, but two interest rate increases at the time. I mean, is this kind of, can you describe the sort of tone of the discussion in the committee? And are we really moving towards sort of a post-pandemic stance? Is there greater confidence that, the recovery will be, a full recovery sooner than expected?
On your first question, the judgment of when we have arrived at substantial further progress is one that the committee will make, and it would not be appropriate for me to lay out particular numbers that do or do not qualify. That is, the process that we're beginning now at the next meeting. We will begin meeting by meeting to assess that progress and talk about what we think we're seeing, and just do all of the things that you do to sort of clarify your thinking around the process of deciding whether and how to adjust the pace and composition of asset purchases. In terms of the two hikes, so let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan. And we did not actually have a discussion of whether liftoff is appropriate at any particular year, because discussing liftoff now would be highly premature. It wouldn't make any sense. In our if you look at the transcripts from 5 years ago, you'll see that sometimes people mention their rate path in their interventions. Often they don't. And the last thing to say is the dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots. So dots to be taken with a big grain of salt. However, so let me talk about this meeting. The committee spelled out, as you know, in our FOMC statements, the conditions that it expects to see before an adjustment in the target range is made. And it's outcome-based, it's not time-based, and as I mentioned, it's labor market conditions consistent with maximum employment, inflation at 2%, and on track to exceed 2%. And the projections, they give some sense of how participants see the economy evolving in their most likely case. And honestly, the main message I would take away from the SEP is that participants, many participants, are more comfortable that the economic conditions in the committee's forward guidance will be met somewhat sooner than previously anticipated. And that would be a welcome development. If such outcomes materialize, it means the economy will have made faster progress toward our goals. So the other thing I'll say is rate increases are really not at all the focus of the committee. The focus of the committee is the current state of the economy, but in terms of our tools, it's about asset purchases. That's what we're thinking about. Liftoff is well into the future. The conditions for liftoff were very far from maximum employment, for example. It's a consideration for the future. So the near-term thing is really, the real near-term discussion that will begin is really about the path of asset purchases. And as I mentioned, we had a discussion about that today and expect to, at future meetings, continue to think about our progress.
Thank you. We'll go to Nancy Marshall-Genzer from Marketplace.
Chair Powell, continuing in that vein, when you're ready, how will you go about signaling the start of tapering when you do decide to do that?
So our intention for this process is that it will be orderly, methodical, and transparent. And I can just tell you we see real value in communicating well in advance what our thinking is, and we'll try to be clear. And as I mentioned, we'll give advance notice before announcing a decision to taper. And so all I can say is that we think it's important. We think where the balance sheet's concerned, a lot of notice, as much transparency as we can give, and as far in advance as we can, to give people a chance to adjust their expectations. And, we expect to be in that business until we reach substantial further progress and then have a decision. Again, I have nothing further on time. It wouldn't be appropriate to say we're going to have to see more data. We're a ways away from substantial further progress, we think, but we're making progress.
So you can't say generally how far in advance you would signal.
Again, as we approach that goal, we'll provide as much clarity as we can.
Percent inflation. Plan to suppress inflation in outer years because over the next 3 years, you're going to be above inflation. So what is your look back period? Does the committee have one? And if not, why not? And if they don't, why isn't this just flexible inflation targeting without an average in a range of 2 to 2.25%? Thanks.
So as part of our 1.5 year long process, the review that we did and came out with at the end of that with the new statement on longer run goals and monetary policy strategy, we looked carefully at the idea. We've all read all of the literature around different formulas for makeup and things like that, and we concluded, and I strongly agree that it's not wise to wed yourself to a particular formulation of that. So we did adopt a discretionary. There's an element of discretion in it. It says that we will seek inflation that runs moderately above 2% for some time, and it's meant to create a broad sense that we want inflation to average 2% over time, and that under the old formula, under the old framework, what was happening was 2% was a ceiling because all of the errors were below. You were always getting back to 2%, so you were bouncing back and forth between 1.5 and 2, and we wanted them to be centered around 2. So that's the approach that we're taking. You're right. It's not a formula-like approach. We were clear on that when we announced the framework. Was there another part of your question, Craig?
That pretty much answers it, Chair Powell. Thank you.
Thank you. Now we'll go to Michael Derby.
Thanks for taking my question. So I wanted to ask you about the reverse repo usage that we've seen lately. I was curious if you are at all concerned about the level of money flowing into the reverse repo facility, and do you believe that the changes in the Fed's rate control toolkit today will have any impact on that? And then in a related question, do you think that Fed asset purchases are taking too many safe assets out of the market right now and creating maybe some dislocations in the money markets?
So on the facility, we think it's doing its job. We think it's doing the reverse repo facility is doing what it's supposed to do, which is to provide a floor under money market rates and keep the federal funds rate well within its range. So we're not concerned with it. It's doing. You have an unusual situation where the Treasury General account is shrinking and bill supply is shrinking, and so there's downward pressure. We're buying assets. There's downward pressure on short-term rates, and that facility is doing what we think it's supposed to do. Sorry, your second question was again?
Yeah, I mean, the change in the rate control toolkit, will that have any impact on, do you think that will reduce the amount of money coming into reverse repos? Will that have any impact on money market conditions that, beyond the Fed funds rate setting?
It could have some impact. I think we'll have to see empirically, but it's designed to keep the federal funds rate within the range, and I do think it could have some effect on broader money market conditions below as it relates to, the very low rates and the downward pressures.
Okay. And do you think it will lower uptake on the reverse repo facility, or that's just not even really a focus of what the change was?
It's not. It's honestly, and the funny thing, you would think that it would, but we'll have to see. It's possible that would not be the case. Well, that's going to be an empirical question.
Okay, cool. Thank you.
I will go to Gina Smialek, The New York Times.
Hey, Chair Powell. Thank you for taking our questions. I was wondering if you could follow up a little bit on your response to Rachel at the very beginning and talk a little bit about how we should understand what full employment means in a world that, as you mentioned, is pretty roiled. All the data has been pretty roiled by the pandemic, and we're not really sure where EPOP is going to settle in. We're not sure where participation is going to settle in, and wages are already looking, decent. So I guess I wonder what full employment means in this context and sort of how you're thinking about those wage data.
Yeah, as you well know, there isn't one indicator we can look to, and there's no one number that we can therefore point to. We look at a range of indicators, and it's a very broad range. You can count to a high number just quickly, but certainly it will include things like unemployment and participation and wages and many different flavors of that. So how do we think about it? A couple things. We're all going to be informed by what we saw in the last cycle, which was labor supply outperforming expectations over a long period of time. Now, that hadn't happened in many other cycles, but this was a very long cycle. So we're going to have to be alert to see whether that can happen again. It's a different economy. We have had a slew of retirements, and that may weigh on participation. That effect, though, should wear off in a few years, and as you move through that window, because people would have retired anyway, and you'll be back where you would have been. So I think the lesson number one is just to be careful about assessing maximum employment, and I think during the last cycle there were waves of concern that we were reaching full employment as early. As 2012 when I arrived at the Fed, and 8 years later, we were still creating jobs, and it was quite remarkable. So we're all going to be informed by that. At the same time, we understand this is a different economy. The demographics people are getting older, and that should have a secular effect of reducing participation over time. So we have to be sensible about what can be done. But I think we're going to lean into that and be optimistic. You asked about wages. We're seeing wage increases. That's sort of a natural thing to be seeing in a strong economy. And what we're seeing is that we don't see anything that's troubling in the sense of what would be troubling would be very wide across the economy, wages at unsustainable levels. Without high inflation. In other words, wages in excess of productivity and inflation by a meaningful amount broadly across the economy, sort of forcing companies to keep raising prices and getting into a wage price cycle. That's the old formula one of the old formulas for having high inflation. We don't see anything like that now. We do see high wages. We see them for people who are mostly new, entering into new jobs, many of them in low-skilled jobs, and but we do think you've got a thing in the labor market right now where supply and demand are just not matched up well, and we think it's a flexible economy and it will clear. There will be a level at which supply and demand meet, and we think that'll be happening in coming months. So, but the last thing I'll say is again, if you look at the forecasts, we're going to be in a very strong labor market. Pretty quickly here. There's still a big group of unemployed people, and we're not going to forget about them. We're going to do everything we can to get people back into work and give them the chance to work. But there's every reason to think that we'll be in a labor market with very attractive numbers, with low unemployment, high participation, and rising wages across the spectrum. So that's a little bit how we're looking at the labor market.
So currently, as Mateus says, that he is saying kind of what we've already been saying, but the thing is, one thing is to hear it from Jerome Powell himself to say what are they looking for. So I don't know if you're doing, but I have a pen, I have a piece of paper, I'm taking notes as we go through. So we can use that again. So we can also look at the same numbers as they do. So we then can come back and say, aha, we know you're going to increase your interest rates before you do it, and we can front run you. This is money, people, okay? This is knowledge. This isn't like whatever, okay? So that's one thing. Another thing is, way more people have subscribed to this channel as through right now. I do highly appreciate that, though, by the way. So for those who are coming in right now, thank you very much, by the way. I do highly appreciate that. But let's go back to this Powell guy. Let's see if it's... The thing is, what I'm looking for, if he messes up. That's what I'm looking for.
Thank you. Now we'll go to Hannah Lang at the American Banker.
Hi, I wanted to ask about the status of your thinking around the supplementary leverage ratio right now. Is the Fed still thinking about ways to permanently adjust this to account for the high growth in deposits? And do you ultimately believe a permanent fix is needed? And any information on the timing around that would be helpful.
I can say is we're working on it. Don't have anything to share with you in terms of the particulars or the timing right now, unfortunately, but we've always, our position has been for a long time, and it is now, that we like the leverage ratio to be a backstop to risk-based capital requirements. When leverage requirements are binding, it does skew incentives for firms to substitute low-risk assets for high-risk ones. It's a straightforward thing. And because of the substantial increase in reserves, treasuries, and other safe assets in the banking system, the SLR is rapidly ceasing to be the intended backstop for our big firms that we want it to be. So we do think it's appropriate to consider ways to adapt it to this new high reserves environment, and we're looking hard at the issue. We would also, just to be really clear, we will take whatever actions are necessary to assure that any changes we do make or recommend do not erode the overall strength of bank capital requirements. So sorry, I can't give you any more. That's just something we're working on.
Thank you. Now we'll go to Annika Tappa at CNN Business.
Hi there. Thanks for taking my question. Chairman Powell, the price jumps we've seen in some raw materials, lumber, for example, you mentioned it earlier, seem to be easing, and it looks like we're in the beginning of suppliers catching up with demand. But I wonder if you're worried at all if we're going to end up with excess supply immediately after those shortages were off, and if we just continue this mismatch as we're recovering and getting out of the pandemic economy. And I wonder how that would affect the Fed's outlook at all.
Well, that is really not the problem we're having right now. But actually, people who work in commodity industries are very focused on that, because they know that they don't want to build capacity and then find out that it's not necessary. So really, the problem now is that demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there. But in terms of overcorrecting, I mean, I think there is a possibility on the other side of this that inflation could actually be quite low going forward. But that's not really where our focus is right now. Our focus right now is we need to. Our expectation is that these high inflation readings that we're seeing now will start to abate, and that's what we think, and it'll be like the lumber experience and like we expect the used car experience to be, with things like airplane tickets and hotels, which are the other two factors in the most recent CPI report that went up a lot. We expect that those prices will get back up to where they were, but there's no reason to think that they're going to keep going up a lot. Because if they are, people will build new hotels. There's no reason for supply and demand to be out of whack in the hotel business over any period of time. So we think that'll happen. I think in terms of the timing and the effects on inflation in the near term, there's a lot of uncertainty. The overall story is one that we think is right, and we think the incoming data support it. And so do many forecasters. And if you look at the forecasts on the FOMC, you will see that as well. But we don't in any way dismiss the chance that it can work out that this goes on longer than expected, and the risk would be that over time it does begin to affect inflation expectations. And if we see inflation expectations and inflation or inflation moving up in a way that is really materially above what we would see as consistent with our goals, and persistently so, we wouldn't hesitate to use our tools to address that. That's it. Price stability is half of our mandate, and we would certainly do that. We do not expect that, though. That is not our base case, and in that we're joined by many other forecasters. But there's a lot to be humble about among forecasters. Forecasters have a lot to be humble about. It's a highly uncertain business, and we're very much attuned to the risks and watching the data carefully. In the meantime, I would say, we should, as I mentioned earlier, there's so much uncertainty around this. It's just a unique situation that we need to see how things evolve in coming months and see how that story holds up and act accordingly.
Okay, let me take let me take some questions here. I can see you, Maida. I understand you, Maida. So the thing is, Maida, the reason why that the strong dollar is there today is because in the dot plot that for 2022 and 2023, I think it's like almost all is thinking increase in 2023, and from 4 to 7 is thinking in 2022. So that is an improvement. So interest rate increase is coming closer. Then the GDP forecast GDP comes in at 7%, up from whatever 5.8 or whatever 6.8, whatever it was. Can't remember right now. So the reason why dollar is today rising is because we now have the first step. Okay, he has not talked about tapering. He has not talked about the framework. He has only said we see that the improvement in the inflation has improved, but unemployment, the labor market is not where they want it to be. So they still need to see that coming through. And he mentioned the lumber crisis. He mentioned the lumber crisis and the commodity. He also mentioned the stock market. The thing he mentioned about the stock market, he said that that market has risen higher. Okay, he did not say the market is crazy, the market is high, the market is unbelievably. He said it is according to our framework that the market has risen higher in reference to the stock market. So he just said that is kind of what we expected. That's what we wanted. So hey, that is cool. So what we're seeing right now, we are at a rebalancing place. And Ahmed asks, is this strength going to happen throughout the summer? Or are we now going to have just, a short-term rise in price? So when we come into the monthly period points, we all see 91.50 as a target. Can that be a possibility? Yes, it can totally be a possibility. So if we then come in for July at M3, I think we might see that, because remember, FOMC meeting, the Fed is, so we have, let's say 1, 5, 10. 10 is full capacity, okay? So we went from 10 down to like here, and then the Fed starts to push it like up to here. But now the market, the economy, needs to push that up to a 10 again. So what the Fed is doing is just trying to push the market in the right direction. But when the Fed starts unwinding whatever they're doing, there is going to be a price correction, and then the market's going to take over. Because remember, back in 2019, the Fed wasn't supporting. The Fed had an interest rate at 1.75. It had no bond purchases, no agency mortgage-backed securities purchases, nothing. So it's just until we reach a point somewhere here where the economy says, hey, I can take care of it, you know? It's like you're helping a little brother. He's not as strong as you. You're the big brother. Rawr. You're beefy, you know? So you're just trying to help him out to try to lift those limbers, those logs, over across the river. So until you can do that yourself, until you're strong enough, until you have fed enough, you can do it yourself, that's when the Fed will start pushing back and say, hey, brother, I can see you're doing well. You're very much welcome. Let's do that, okay? So really, the news today, the news value today was, news. It was the economic improvement. That's only. That they acknowledged that. And the dot plot, meaning that they're, whatever they're thinking at the moment, today, they're thinking that we are most likely going to increase rates in 2023, but at the moment, more likely than yesterday, that we were going to increase interest rates in 2022. When you're coming into this Fed tool, is there any change? As you can see here, now market starts to price in a different scenario. We were at 92 earlier before the meeting, now at 83. This might change over tomorrow as well, where we are at maybe lower prices and saying, hey, maybe there's in December 2021 that there might be even more people thinking, are we going up to 50, 75 basis points? Who knows? So, yeah.
Statement you dropped the language saying that the pandemic is weighing on the economy. So is this the effective end, in your view, of the pandemic as a constraint on economic activity, even though it's still cited as a risk?
You know, it's a continuum, right? What you've seen with the pandemic is sharply declining cases, hospitalizations, and deaths, and that's great. And you know that should continue. But you know you also saw in the United Kingdom, which has I think at least as high, if not higher, vaccination rates, they've had an outbreak of the Delta variety, and it's causing them to have to react to that. So you're not out of the woods at this point, and it would be premature in my thinking, it would be premature to declare victory. Vaccination has a ways to go to get to levels. It would be good to see it get to a substantially higher level, and you know that can only help. You're right. The statement language is evolving. I would expect it to continue to evolve. There's a lot of judgment in that, but you can expect us to drag our feet a little bit on that because that's what you do with statement language. It's great to see the progress, but again, I would not declare victory yet. I would say it is so great to see the reopening of the economy, though, and to see people out living their lives again. You know, who doesn't want to see that? And it appears to be safe, and I just would encourage people to continue to get vaccinated.
If I could follow up on that, if you view the statement in toto and the dots and the steps as well, do you think this is more a mark-to-market exercise around the improvement in health or around the inflation risks you see developing out there?
I think it's both. No, I think clearly since March, what's happened is people have grown more confident in these very strong outcomes that they'll be achieved. Very strong outcomes in the economy will be achieved. There's more grounds for confidence. We've seen growth come in higher than we expected. We've seen very strong labor demand. We've also seen we have seen inflation above target, though, and I think even though you know in our forecasters' case they do see inflation coming back down over 22 and 23 into areas that are very consistent with our mandate. Nonetheless, the risk is something that can factor into people's thinking about appropriate monetary policy. The thing is, these are 18 different forecasts, and I can't stand here and say exactly what was in all 18 people's minds, but that is something that I think can factor into things as well, factor into our forecasts as well.
Thank you.
Thank you. We'll go to Victoria Guida with Politico.
Hi, Chair Powell. I wanted to ask a little bit more about inflation to make sure I understand how you're thinking about this. So in the projections, inflation is expected to be high this year and then come back down next year, and then maybe start to rise a little bit again, enough for a liftoff in 2023. I know that's obviously, take that with a grain of salt, but that would suggest that you all could theoretically see inflation sustainably staying above 2%. And so I guess my question is, what would be causing that inflation? What would be, because it seems like you all now see a situation in which inflation would be rising in a way that isn't caused by transitory factors in the next couple of years. So would that be the result of a tight labor market? Would that be because this whole situation has raised people's inflation expectations? How are you thinking about that?
So what we're seeing in the near term, again, our base case is that what we're seeing in the near term is principally associated with the reopening of the economy, and not with a tight labor market or tight resource constraints, really. But you're right. When you get to in the forecast, all of that, the supply and demand sides of the economy adapt. We have a very highly adaptive, flexible economy, more so than most. And by 2023. Those increases are really about rising resource utilization, or to put it a different way, low unemployment or high employment is the way to think about it. So that's what that's about. That's about the kind of broad inflationary pressure that results from a really strong expansion, tightening up resource utilization across the whole economy, and lifting up inflation. That's why, and that's why you would see it then, because by then, in the forecast, and it's just a forecast, they're just individual forecasts. In people's forecasts, that's what's happening.
So the change of the projections reflect the fact that you all are more optimistic about the economic outlook, and not necessarily that you think that this will change the way people think about inflation.
Yeah, I think there may be an element of the latter as well, because inflation expectations have continued to move up. It's all in people's individual thinking, and you can't. It's hard to say. It's not something the committee debates in terms of what the outlook is for 2023. So I'm a little bit speculating, which I shouldn't do. But I wouldn't surprise me if there's an element for some people in seeing the inflation performance that we've had, and thinking that I have more confidence that we could see inflation above 2%. That it may not be as hard to do that as we thought. And that inflation expectations may move up to a level. They were really at a level that was kind of a little below 2%. They might move up as a consequence of this, or as a consequence of the new framework. We did see inflation expectations moving up in the wake of the announcement of the framework, but we don't really know that. So ultimately, I think it's consistent with both those things.
Thank you. Now we'll go to Greg Robb at MarketWatch.
Hi, thank you for taking my question. Chair Powell, I'm just looking at the forecast, and one thing I just don't think it's been talked about all that much is how much the Fed thinks that the economy is going to slow next year. I mean, are we looking at a scenario of a slowing economy next year as with higher inflation? And what do you think about that?
We're looking at an economy that will not have the degree of fiscal support. The fiscal support in the forecasts is much less than it was this year. But you've still got a very strong growth, well above the longer run potential output of the economy. You've got growth meaningfully above that, and inflation is lower next year in all of our forecasts. I think the range of core PCE forecasts for next year is 1.7 to 2.5 in 2022 and 2 to 2.3 in 2023. So You're right. You're seeing, I can't remember the number, but it might be in the 3.5% growth for next year. That's a really good year. Coming on the back of a 7% growth year, that's a really good year. That's a year with a lot of momentum. That'll that'll cause significant job creation, and it will. I mean, we would take 3.5%. We didn't have a 3.5% growth year. We didn't have a 3% growth year between the global financial crisis and the end of the expansion. So that would be a good year.
Doesn't it seem like there's a risk of like stagflation, where that you're going to go from 7% and down? That means the economy is really dropping in some way. We haven't seen that, right? That's
well, it's just the economy's not the economy is still growing, and growing at a very healthy rate. Our estimate, I mean, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess to answer your question a different way, is there a risk that inflation will be higher than we think? Yes. As I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes, and if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
Thank you. Going to Brian Chung with Yahoo.
Chairman Powell, Brian Chung, Yahoo Finance. On that point, you talked about maybe some of the more structural changes in that last answer with regards to productivity. I noted that the median projection for R-star, the longer-term interest rate, is still the same at 2.5%. But there's been some literature out there that maybe the COVID crisis could have actually changed some of the underlying fundamentals of the economy and maybe changed productivity, in addition to combine with demographic changes that have already been in effect, to suggest that longer-term neutral rate, or R-star, might be higher. What would the implications of that be for monetary policy? Do you think that maybe the Fed could have the possibility of underestimating the long-run neutral rate, and what might be the impact of that?
A higher neutral rate would mean that interest rates would run higher by that amount, and that would be a good thing from the standpoint of the economy, because it would give the Fed more room to cut rates. The problem with interest rates being close to the lower bound, of course, is that it really cuts into our ability to react to a downturn, for example, a pandemic. And if you look, for example, at the European Central Bank, their policy rate was well below zero when the pandemic hit. So we don't want to be in a place where we can't react. A higher neutral rate would be, from that narrow standpoint, would be a good thing for us. It would give us more room, and therefore then that would tend to result in better outcomes for the economy over time. You can't estimate it with great precision. I think we would be alert to, studying R-star is a whole industry unto itself, and I think we would be alert to factors that might raise R-star, the neutral rate of interest, and we'd try to keep up with that. And I think we're all thinking about that and the possibility of that. There are a lot of stories right now that essentially could lead to higher productivity growth and higher R-star. We don't know which of those stories will come true, but I'll give you an example. It's just there are a lot of startups, a lot of early stage companies, and is that going to have that effect? We don't know, but we'll be watching those things carefully.
Great. Thank you. For the last question, we'll go to Michael McKee at Bloomberg TV.
Mr. Chairman, of course, you'll be shocked to learn that you have some critics on Wall Street. And I would like to paraphrase a couple of their criticisms and get your reaction to them. One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements, but if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period at which you announce a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there. But so let me say first, I think people misinterpret the framework. I think there's nothing wrong with the framework, and there's nothing in the framework that would in any way interfere with our ability to pursue our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're strongly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we've written down, our committee is solidly behind them. The forecasts are all consistent with that. Your specific question, I guess, was will we be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. The current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation is nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is how do you separate in inflation? How do you separate things that follow from broad upward price pressures from things that really are a function of sort of idiosyncratic factors in due to particular things? I mean, a classic example was, to pick a narrow example, was the cell phone price war back in 2017. If you remember, prices were incredibly low, and it held down core PCE by 0.3 or something for a year, and then it fell out. So this is much bigger than that. And of course, it's not easy to tell in real time which is which, but that's the question you would face under really any framework. And we're trying to sort that out. I've tried to explain that today about how we think about that. And we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate. Your second one was, we will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that, and that's what we're doing. That's what we're going to do, and we will follow through on that. There's no, we will do what we can to avoid a market reaction, but ultimately, when we achieve our macroeconomic goal, we will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy. And the history of the Fed is that sometimes you go too far.
That's right. And we have to balance the two goals, maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that it has an effect on activity, and that's one of the channels through which we get to inflation. We don't think that we're in a situation like that right now. We think that the economy is recovering from a deep hole, an unusual hole, actually, because it's to do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to, to bring supply back up to snuff. That's happening all over the world. There's no reason to think that that process will last indefinitely. But we're going to watch carefully to make sure that evolving inflation and our understanding of what's happening is right. And in the meantime, we'll conduct policy appropriately.
Thank you, Mr. Chair.
Thank you very much.
Right. So, how can we sum up today then? Whoosh! How can we sum up today? What is like the biggest headlines? What is the most important thing to mention today? Let's get it out there. Let's take away some things that does not need to be here at the moment. Why can't you go away? Gå ut. Sånn. Kjapp deg. Gå vekk, sa jeg! Fed meeting. Yeah, we have all those things. So, tell me, people of good people. Where are you guys? There you are. Cool. Did somebody crash? Did it crash on me now? That's fun. Okay, working through it, working through it. Flott, da. Sånn. There you guys are. Sarah, wow, I'm sorry. USD is bearish, yeah. Mess. Yeah. I guess that's one word of putting it. Nasdaq turns back positive because Fed said the market was great. Pound dollar is testing the swing area. Euro cracked below the 100-day moving average. Powell, it's clear we're on a path to a very strong labor market. US Swiss moves to test the highs from June. Powell opening statement, indicative activity and employment continues to improve. That is kind of what I would agree to do. And yeah, we are here. We survived the bloodbath. We are very much alive, I would say. And I'm just kind of reconciling with, different news sites that I have here right now. Coming into the institutional research as well. And yeah. Nothing here. Cool. Then Forex news. XAU, new critical support at 1822. I don't know if I agree though. But cool. So, key quotes. There's nothing in the framework that interferes with our ability to pursue goals. We are not facing a situation where we're behind the curve. The question we face with inflation is nothing to do with the framework. The question is, how do you separate broad upward prices pressures from idiosyncratic factors? What I kind of understand from that is, the question is, how do you separate the broad upward prices from things that is kind of not really supposed to happen now, which is supposed to be idiosyncratic. I guess it's not like it's not in sync, I guess. Google. Okay, anyone? What is the definition of idiosyncratic? We all need. or something peculiar to an individual. Okay. Cool. Not all survived. I'm sorry. KT, gold is still getting killed. Is this the end of the near sight, do you think? Promising, but not out of woods yet. Not all survived. I don't understand. Do you know how much... My point crypto is that the current move on the gold is not over. We have not reached support. We have not turned around higher. We are not in a bullish pressure at the moment. So I don't know how far gold can fall before we have the turn. That's why I asked how much. Maybe I should change that to say I wouldn't buy at the moment because it's currently falling. We are not buying when it's falling hard after FOMC meeting. We would buy after it has stabilized and made a higher high, higher low. This is where you buy. You don't buy here, okay? Just after the FOMC meeting. So I don't know how far we will go before we start rising again. That's kind of the situation. And yes, and you have stop losses. But crypto, someone doesn't have stop losses. Someone doesn't know what stop loss is. I have countless people coming to me saying, Ivan, what do I do? I bought euro at 1700. I bought at 1900, where it's 122. What do I do? Help me out. There is, if you feel attacked there, there's many. Don't worry, there's many of you that has come to me. So some people can't take stop loss. That's why I say it, okay? So it's naive of me to think that everyone has a stop loss because someone just starts to hedge instead, okay? So that's kind of the situation there. So where was I supposed to go? I was talking, I guess. Yeah, it's a question you would face. Well, would you think these are temporary factors? They will wane. They still think that we are in transitionary market. We will taper when we feel the market has reached sustainable further progress. T2ish, thank you for subscribing. Boom. Hope you are doing well today. We all do that. We can avoid. We will do that. We will do what we can to avoid a market reaction, which is mentioning the taper tantrum last time they tried to unwind. It went horrible, by the way. Okay, it did not go well. So taper tantrum, when is that happening? That was 2013, where a reactionary panic triggered spike in dollar treasury yields. 2013, we go to yields, daily, 2013, 13, here. This is taper tantrum apparently. So that is around 7th of May. Going into dollar, 7th of May. 7th of May. Dollar did not have the same move, but it was referred to the US yields, apparently. Cool. Great. Then. Economic is recovering from a deep hole. Turns out it's a lot easier to create demand than to bring supply back. So he was talking a lot about supply and demand, okay? So supply is an employer giving you a job. Demand for a job is you as an employee asking for a job. So apparently he said he was talking about supply as well. Is coming. It's not there yet, but it's coming, kind of a thing. Bro, how about market seasonal on July? So which one weighs the most, seasonality or the Fed? Well, generally speaking, if we don't have a crazy situation where we have a totally new information, the Fed is going to crash the market, then seasonality will figure itself out. Though, remember that this can create trends that goes against seasonality and have prolonged dollar strength. But I need to calm my mind. I'm thinking very fast at the moment. I can't think straight. So when I come back to my hole, I will think through it. I will look through some charts. I will look through what has happened before. If there's anything that can indicate into what has happened at any point, or just by flipping the coin, are we going to be bullish, are we going to be bearish? But I will try to find some statistics, something that would give us some kind of view out for the future, so we can have. But who wins in the end? The Fed. The Fed wins over seasonality. So we need to be humble for that. Okay? So because, or like, this is seasonality and this is seasonality. But also do remember that we did in this crisis rise skyrocket and then in the end we start falling. Most of it is Fed. Okay? Most of it is Fed. So yeah, what else? What is I supposed to say? Yeah, so they are far away from where they want to be. They're not at where they want to be, and growth next year is a bit higher. That's kind of the main points. Why is DXY pumping so much when interest rates stay the same? I struggle with this. Okay, weekly close. Okay, you have. Sorry, I'm not going to be rude with you. I'm going to be kind to you, okay? I'm not going to be rude with you. Please subscribe to my channel so I can teach over time. One. Second of all, interest rates is one thing, but what is behind interest rates? What is the expectations of future interest rates? Okay. So currently, the interest rate is currently the same. Yes, but the expectation for future interest rates just went higher. Okay? That is one thing. That there is more Fed members thinking we're going to increase interest rate earlier than the previous meeting. That sends dollar up. The other thing is economy. The GDP, the CPI, CPI was also forecasted higher. I think GDP for 2021 is supposed to be 7%. 3 is a good year. We are at 7 this year, according with the forecast would be for this year. So we are super hot this year. And next year was supposed to be 3.5%, up from whatever that was supposed to be, maybe 2, around 2 somewhere. So when forecasts for the future interest rate economy is lifted to today, we need to change and we need to cater that information into our trading. So that's what the market is doing right now, is rebalancing basically. So the dot plot, which is the what the Fed members are thinking about, they have more bullish and more positive on the economy. The statement from the Fed is more bullish than the previous one, and they're also acknowledging the improvement in the economy. When the Fed says that they're acknowledging the improvement in the economy, then that's set. Everyone else sees it. Now Fed sees it too. So now we are kind of taking the facts from what the Fed has said and move forward. Everyone else could see the CPI. Everyone else is seeing the unemployment, the NFP, the wages, the retail sales, all those things. We see the commodity prices. We see the stock market. We see all the prices rising. Now they have also acknowledged that it is rising. They also say the stock market is is expecting, according to their framework, to go higher. So the stock market did not react badly because he said, it is supposed to go higher. He also said that the economy is rising at a healthy pace. That, my friend, is a new word. We have seen for the past year that the economy has had a substantial shock. We have seen that the economy is facing a never to be seen before crisis, but now we're seeing a healthier growth in the economy. Totally different, totally flipped, 100% around. Okay, cool. I hope that was a good answer to you. Do you share signals when you find good setups, or is it only for members? No. Well, if I do share I'm not as good as I should be when I'm sharing when I trade and don't trade. But yeah, it's in the free Discord channel, by the way. It's free. And when I try to mention when I do. I also try to mention in my lives when I'm actually what I'm going to do. I tell you in advance. I don't really tell you when I do it, but I tell you in advance what I've done. Okay. So this is my Discord. Won't help. So yeah, Discord. Free. Nobody's going to bother you. I'm only going to bother you with when I'm going live on YouTube and when I post charts and stuff that is necessary for you, and I post analysis, not my analysis, other people's analysis that I could have done myself as well. So yeah, pretty good there. I think the main concern for the market was the Fed would hint taper this month. Many hedge funds was prepared for that to deal with dollar strength and create hedge plans. Yeah. But I do have only for members, but that's fundamental analysis before the week. I think it costs you $5 a month. So if you go to whatever my channel somewhere, it says become member. It says here on the phone, become member. If you want to, $5 a month for every Sunday. I try to do that every Sunday. It's not a guarantee that I'm always well, that I'm always happy, but yeah, I try to do that. Cool. Awesome. You're much welcome. So I hope everyone is today subscribed to my channel. I shouldn't say that too much anymore. Sorry, Kevin, shut it. Shut it. What is this thing saying? Okay. Let's see if there's any updates on this chart. Thank you, people. Wow, thank you. Thank you. Aww. Aww, you guys are so cute. You guys are so kind. Aww. Puppy. Anyways, so yeah. Yeah, I think we can kind of look into what he's saying. Market has been up. Market have taken the upbeat message from the U.S. economy, from the new set of economy projections from the chair, that the growth has raised to 7% from 6.5 PCE, and all those things. I'm just going to copy that. Cool, whatever. Can't post it even. Cool. So, and then the Fed's fund rate. Yeah. So yeah, I've been here for 2 hours and 22 minutes at the moment. What else should we talk about? I feel like I've said things many times at the moment. And I think the market just needs to relax a bit. Gold is falling again. Yeah, so that's what... Okay, let's go with some technical analysis here, okay? Let's go from the top. Which pair should I cover? Which pair should I cover? I can't even type correctly today. Okay. I've just gone through most of the pairs that I would think that you guys would like to go into. KT has said gold. Okay, so what are we seeing here at gold at the very moment is that it has broken support. It has broken support. It is coming into support. So it will always be at support. Okay. Now, hedge fund managers are now taking profit or hedging, depending. Okay. So either they're selling it or just taking profit. Remember, this is coming from far. You know, you can see gold is falling right now. But this is people that bought in this. That might also be taking profit now that they're seeing, is what we thought about gold still the same? We're seeing that the economy is improving. Is the crisis still there? No. So somebody would say that we will take profit when the Fed says the economy is improving, and now they have said that. Okay. How long is gold strength going to last? Days, weeks, months. I would hope that we by Monday would change direction. Okay. That was my hope. That's still my hope. So right now we're just falling. Dollar is just rising. Gold is just falling. It is currently untouchable by buyers and sellers. There's nothing we can do. It is just there. We just have to sit and watch. Not because that we should have sold it, we should have bought it, or whatever. No. Technical analysis right now, it says it's in between. It's not falling. No, it's falling and uncontrollably falling. As we don't know where it's going to go, we can have some trade plans of where we should and where we want it to go, but we don't really have the most important things. Okay, so I can only say I want this to go higher, I want this to go higher, and I want this to go higher. That is kind of what I would say until the end, until you get bored of me. But shouldn't I sell? You should have sold it, bro. Why didn't you sell it? Why you're so stupid? You didn't sell it. Well, I didn't plan for it, so I can't sell it because I didn't plan for it. And if this one went up here and I sold it, I would look like a lunatic. And I would probably crash my account. Okay. So if they did the same amount just upwards instead of downwards, yeah, it would not have been pretty. By the way, it would have been up here. It would not have been pretty. So I didn't take the chance. I didn't plan for it. Gold is approaching the 3.8 retracement. Great. Broke through M3 monthly. Yeah, there. It has broken through 23% retracement. So there is a retracement we always need to think about when it comes to gold. 618. Okay. Where is the target for the month? Around 618. So that's the long-term sell target that we need to be aware of. Okay. Cool. So yen pairs is requested by 2 YouTube members that's paying minimally $5 a month. They have priority. So we will go through yen pairs before anything else. Alright? Just because they're paid, I will honor their wishes first. Because sometimes there's a million wishes. That's all. So, where was it? That was price to remember, 1770. Australian dollar yen. So which one will not benefit from this dollar strength is Aussie, New Zealand, CAD, pound, euro. This one will fall by itself, and it has fallen by itself. Aussie yen is coming into a more of a buy zone for me, more than anything else. Because this is not directly, just because it goes well or better in America, doesn't make this bearish. The shock today is down, yes, I agree. And we have broken below M2, yes, we have. But I will definitely buy in July. Or next week, depending. So, currently we have a lower low, which is unfortunate. Det mulig da? It's unfortunate. So, cool. That's what it is. Price is not bullish. We just have to wait. Yeah, I said 1760, so 1770. Euro USD, good night. We can do that. Gamblers, which one did you say, Gambler? Did you say anything? No, you didn't say anything. But yeah, cool. So which pair would you want to cover, Gambler, so I can remember that too? But I will go through fast. It's very fast at the moment because, you know. So what do I want to see? Double bottom, higher high, higher low situation. And there I can start not buying there maybe. Yeah, I don't know. I need to break this resistance, by the way. Hopefully we'll get some kind of, you know, some kind of bullishness we can buy here in July. We shall see. But yeah, need to reverse it, back up again, and break this resistance. Cool. CAD yen. Also, I don't like it. I really don't like it. It's not bearish per se, but it's not making higher highs. So kind of like that situation maybe. Yeah. Oil. Yeah, I will. Okay. I'm done with CAD yen. What's the target? Probably 92. But so far it's, you know. So we can do oil at the very second. It came up to M3, double top. I think that was the top. So I'm not saying we should sell it now. It hasn't made a lower low yet on this time frame even. So what do you want to see? Higher high, higher low, and then you need to break below that low here. So you need to break below 71. We are currently at monthly TP. And we are currently at weekly TP, I think it is as well. So yeah, this one is too overstretched. But yeah, it's still bullish. So if you want to sell it, you need to break below 71. But currently, yeah, cool, maybe. But it's very overstretched. So just be careful. Don't force it. Don't force it. Small losses, small orders. Euro, yen. And target is probably 67 or 65. Euro yen is kind of still bullish. Coming down to support again. Broke the support, okay. So maybe we will go higher. Maybe. So I'm just waiting for this one. I'm not really interested in this one, so I'm just waiting for this one to turn higher. It can break lower, by the way. But so far, still holding, but I'm not going to engage right now. This is not a place I want to engage in because it has 100% retracement. It's currently at support. That is not a good place just alone. You need support to be here. That's good support. You need to be here. That's good support. This is not a good support. Viggo, hva tenker du om US 30? First of all, is that the Fed said that we are not going to, that we are like they said, what did they say? That in their framework, like in their system, in what they want to do, they also want the stock market to rise. So they're just acknowledging that it's healthy, like it's good. Like if you drive forward, you kind of expect your car to accelerate, kind of a thing. So it's cause and effect. So they're okay with that. So I will then, yeah, I will add it to my list. I will go through it very quickly soon. Viggo Ball, just subscribe. Thank you very much. Takk. Takk skal du ha. Jeg snakker mest engelsk, da, men I can respond in Norwegian if you want to. In text. Cool. So pound yen. We want kind of this one to go higher. So it's I don't like this. Maybe it's turned around today. Maybe, you know, never know. But it's pound yen. It can fall like that and then go higher again. So I'm not prepared to invest anything here. This is like, okay, you know, we are just here. Yeah. So I'm not here to catch bottoms, by the way. And this was the buy this week here. And we came down almost 100% back down again. We've been ranging and now we kind of fell. So it's mediocre. It's like, whatever. I want better price action. I want better momentum. I want something better. This is not what I want to see. So New Zealand yen currently bearish, currently falling. So we need to double bottom, higher, high, higher, low. Some kind of reversal. So, meh. You get a sad mouth from me here. Cool. You have a buy position from January Gambler. Okay. Yeah. Also, you are at very extreme levels at the moment. You're at monthly take profit. And if you like that move, also, of course, you can hold it for longer. But you are overstretched, by the way. But it can definitely continue. With current CPI going higher, you have the momentum behind you. But if it's short term falls down to 66, okay. It, for me, doesn't really matter. It's like an open field of support here. So it doesn't need to, but if it does, it would be a good buy opportunity. Kind of thing. Okay. Good on yen pairs. Good on oil. More questions there. Euro USD and pound dollar. Well, we can go through that. I want Euro USD to hold 120 for the simplest reason is if we fall below here, we already fallen below all those other things. But if you fall below 120, it makes it more difficult to maintain bullish trend. I can see we have turned around. I'm not blind. And Danske Bank is have a target of 1500, I think it is, or it's Nordea. A couple of them are thinking 115. ING, Westpac, some other banks are thinking 125. So which team are you on? Both of them are valid. Some of them will be wrong. But Danske and Nordea have been thinking 115 for the past year or something. It's like for a long time. So I don't know if they will ever hit it. But yeah. Maybe now. Maybe now. Nice! The other thing is, if I've given you value today, any knowledge, anything that you didn't know from before, please hit the like button. Yeah. Pound, coming down to 140. That could kind of just fall, whatever. I really don't like pound that much because it moves so much, and whenever direction it just goes, and it takes away all of my money. So I don't like that. It's a home wrecker. when my wife asks, did you make any money on pound today? I'm like, can't you ask me something positive? Like, don't you have anything positive to say today? No, I didn't. Oh, anyways, so yeah, I can't record. Oh, this is so funny, people. I'm dying. Yeah, okay. I can use 30. Okay. Don't want you to hold for long. Apparently I said sell entry back up there. That still holds very great. And I think probably buy from 33.86. This is not from today. This is from, I don't know, I think it's from the 7th of June. I don't know if I made it in the lives or whatever I did, but yeah. Anyways, whatever I'm saying today is not for financial advice, only for education purposes or entertainment purposes. Whatever you do, you make your own decisions. Don't rely on me. I'm only saying what I think, what I will do. So, cool. Anyways, after that, that's kind of where you would sell. This is kind of where you would buy. Are you going to buy here? It's totally up to you. But hey, yeah, that's kind of the thing. That's kind of what you're hoping for. Coming down to M2, it can go a bit lower than M2, you know? It can go a bit lower, but is it a higher high? Yeah, it's a higher low. But what are you expecting price to go? Higher. Why? Because Fed is having lower interest rates and still buying bonds. It's still structured, manipulated, whatever you call that word, to the higher side. Margin higher on pound too. So GU going lower for now. Yeah. I'm right sometimes and I'm wrong other times, okay? So if you're wondering, when did I even do well last time? It's a long time ago, by the way, when I did well last time. But I bought here and went up to here. Okay, this is what I did. 100,000 pips. 100,000? 10,000 pips, sorry. I'm tired. 10,000 pips on pound pairs and yen pairs in this time frame. And I also did euro here. Dollar pairs, other dollar pairs didn't do that. And I tried to sell in this market. It didn't go well. I was terrible trading this one. So, yeah, you know, it is what it is. And I'm trying to buy in this area. Didn't go well, as you can see. So, you know, that's kind of how I do, personally. New Zealand dollar, where are you, boss? I know you hate me for doing this. But New Zealand dollar is falling off the chart. Through the target. Compressed pivots, by the way, but still through the target. And where's it going? It lost most support, I guess. All remember, we have come from 56 to 70, by the way. So these falls are not big. They're just, nah. Cool. Interesting. Alright. USD CAD lastly. Dollar pairs are going higher at the moment. If you bought, you are very late, and it might go higher today, but it can fall tomorrow again. Okay? Okie dokie. You're good. S&P 500 coming a bit lower, but I still wanted to come back to 4160 or 4120. It hasn't done that. Nasdaq should come down to 13,500. Hasn't done that either. But yeah. Any other questions? Any other questions? Questions? I use fundamental analysis first. I use Fed as my guide, as my god. I then look into a financial advice and then look into the economy. How is it going at the moment? I use seasonality. Farmers need to grow. Farmers need to seed. Farmers need to harvest. Farmers need to water. There is a system every single year of the market. Regardless, we need to listen to what the Fed has said. They are markets today repricing, refiguring things out, and I think we're going to have more dollar bearishness coming in at some point. I don't know if it's today or tomorrow, but don't lose hope. Don't lose your account. I hope you have had a fantastic day. I've been here for 2 hours and 43 minutes, and I love you guys. I am done. I'm over and out. I hope that you have got a lot of value, got a lot of tips, and of course you have not lost your trading account. Not that that was my fault, but I hope that you make wise decisions every time. I try to make you maybe do more wise decisions by using knowledge and not feelings before you make any investment advice into any assets whatsoever. Alright, have a good night. Mic drop. Have a great night.